Welcome to today's live webinar entitled To LLC or Not to LLC, Florida Update. At this time, I would like to turn the call over to your host, Karen Orland. Please go ahead.
Good day and welcome to LLC or Not to LLC, Florida Update. I'm Karen J. Orland, an AV preeminent peer-rated attorney licensed in New York and Florida, former chair of the Corporation's Securities and Financial Services Committee of the Business Law section of the Florida Bar, and member of Florida Bar Legislative Drafting Committees for the Florida LLC and Corporations Governance Statutes, concentrating my private law practice and in-house counsel services on business transactions and business entity governance, and my expert witness services on legal ethics and fiduciary duty of attorneys, especially attorneys practicing business transactions and business entity governance law. Please note my contact information on slides 1 and 49 of this presentation. Slide 1 is up now. If you have not already done so, I recommend that you print a copy of this PowerPoint presentation and the accompanying memorandum in your materials entitled Some Judicial Opinions Since 2015 Affecting Florida LLCs. To devote this presentation to its extensive substance and serve the needs of all participants of different states and backgrounds on this call, I shall not take or answer questions during this presentation. Instead, please email your questions and constructive comments to Karen@orlandlaw.com or mail them to me at an address stated on my firm's website, www.orlandlaw.com. I shall respond as soon as I can. Please do not, however, leave me text or voice messages. Also, if you are not licensed to practice law in any state or territory in the United States, unfortunately, I cannot answer your questions regarding specific factual circumstances or parties unless you maintain your primary legal residence in New York or Florida, where I am licensed to practice law. This presentation covers the topics regarding limited liability companies in Florida, generally outlined in, but not necessarily in the order stated in the agenda for this presentation. Each topic, however, appears at the top of each related slide. For those of you new to LLCs, and I note that some of you are not attorneys in practice law in Florida or elsewhere, the correct term is limited liability company, not limited liability corporation, as we often hear or read in mainstream media and even in some legal publications. An entity is either a limited liability company or a corporation, but not both. Slides 2 to 4 of this presentation concern comparisons of business entity forms, corporations versus LLCs, and I'm going to start with a brief overview of taxation of LLCs and its members. As some of you know, LLCs, unlike corporations not electing as corporation status, generally are not subject to double income taxation of their net taxable income. That is, 100% of the net taxable income of LLCs generally is taxed by the IRS to LLC's members, but 100% of net taxable income of corporations not electing as corporation status is taxed by the IRS and the Florida Department of Revenue to those corporations, and in addition, the portion of that net taxable income distributed to shareholders of those corporations as dividends, as distinguished from return of the shareholders' capital investment in those corporations, also was taxed by IRS to those shareholders. Florida does not tax income of Florida individuals residing in Florida, but taxes net taxable income of Florida corporations not electing as corporation status. An LLC, unlike a corporation not electing as corporation status, therefore generally cannot limit the amount of its net taxable income taxed by IRS to its members by limiting distributions by the LLC to its members. I'm going to repeat that. Unlike a corporation that does not elect S corporation status, An LLC generally cannot limit the amount of its net taxable income that is taxed by the IRS to its members by limiting distributions by the LLC to its members. And an LLC, unlike a corporation, regardless whether the corporation elects S corporation status, generally cannot limit the amount of its net taxable income that is subject to Social Security, or FICA, and Medicare tax. I say generally because an LLC can elect to be taxed as a corporation and then can elect to be taxed as an S corporation for Florida as well as federal income tax purposes. Now, why would an LLC consider with its accountant electing to be taxed as a corporation and not electing to be taxed as an S corporation? That is, electing to be taxed as a C corporation. Why would an LLC consider doing such a thing? If an LLC formed and maintaining its principal place of business in Florida has members who are individuals and reside outside Florida in a state taxing at high rates the taxable income of individuals, or those members reside outside the United States, then lower total income, Social Security, and Medicare tax may be payable if the LLC pays federal and Florida income tax on the LLC's net taxable income, calculated after it pays to its members or others reasonable salaries under employment agreements, and the LLC limits distributions to its members. There are quite a few small businesses and family-owned relationships, businesses or relationships among families that are organized as LLCs, the accountants of which elect S corporation status for those LLCs and have each of the members enter into employment agreements with the LLC that result in substantially all of the net income of the LLC for any year being paid to those members in the form of salaries rather than in the form of distributions or not distributions, in order to, again, limit the amount of Social Security and Medicare tax payable by the aggregate group. Now, I am not a CPA or tax attorney, and this presentation is not primarily about tax law. If you are not a tax attorney licensed in the state in which an LLC maintains its principal place of business or its members maintain their primary legal residences, I urge you to consult with CPAs, tax attorneys, and other tax advisors licensed in that state regarding all income and other tax matters relating to that LLC and its members, including, among other matters, the effect of the Federal Tax Cuts and Jobs Act of 2017 that came into effect at the very end of last year. This presentation, PowerPoint, and other materials do not constitute tax advice, and you and your clients should not rely on them or on any other blogs, FAQs, articles, or other advice not provided by a fiduciary specific to that LLC or its members for choice of entity decisions or any other tax planning. For other issues, consider with those tax advisors regarding differences between LLCs and corporations and restrictions on what LLCs can elect as corporation status, who and what persons may be shareholders of S corporations, subsidiaries of S corporations, and differentiations among shareholders' rights other than differentiations as to voting rights. See slides 2 to 4 of this presentation, and slides 3 and 4 I'm displaying now. One of those concerns specifically the restrictions on S corporations that I just referred to. Now we'll move on to a brief overview or a brief limited discussion of Federal Tax Cuts and Jobs Act of 2017 that was signed into law at the very end of 2017. substantial confusion remains even among tax professionals regarding the effective choice of entity decisions of that statute. Information about that statute that I gleaned from blogs and webinars by independent and certified public accounting firms, and not based on my own reading of the statute, IRS promulgations, or my analysis, is summarized on slides 5 to 7 of this presentation. A takeaway for an LLC or S corporation, the principal asset of which is the reputation or skill of one or more of its employees, such as a law, accounting, health, actuarial science, performing arts, consulting, athletics, financial, or brokerage services firm, is that even an individual member of an LLC or an individual shareholder of an S corporation that has that principal asset. In other words, even a lawyer that owns a LLC or S corporation law firm can deduct on his or her individual federal income tax return 20% of his or her allocable share of the LLC's or S corporation's qualified business income. As the term qualified business income is defined in that statute. If he or she is married, filing a joint federal income tax return, and has 2018 taxable income not more than $315,000, or if he or she is single and has 2018 taxable income not more than $157,500. These rules or these limitations are summarized on slide 5 of this presentation. Now, above those taxable income thresholds of $315,000 for married member filing joint federal income tax return, or $157,500 for a single member, the calculation gets complicated, and that calculation and the rule on qualified income deduction is summarized on slides 6 and 7 of this presentation. That deduction is not, that qualified business income deduction is not available for members of LLCs having that principal asset, in other words, a reputation asset, a law firm, an accounting firm, an athlete, a graphic designer, and the like. If the taxable income above the $315,000 or $157,500 threshold, respectively, phases out for members of LLCs not having that principal asset, and higher taxable income, and is calculated differently for members having taxable income above $415,000 for married members filing joint federal income tax returns, and above $207,500 for single members. For high taxable income members, therefore, incorporation or S corporation election may be the better choice. Again, consult with a tax professional to conduct an analysis and number crunching for each business entity based on the circumstances of the members of that respective entity. You can't Google this. We're now going to move on to slides 8 to 10 of this presentation that overviews the common features of Florida corporations and Florida LLCs. What do Florida corporations and Florida LLCs have in common? You probably know that LLCs, like corporations generally, insulate the assets of their owners from liability to creditors of the entity. But you may not be aware that, like corporations, an LLC's veil can be pierced by its creditors to reach its owner's assets for fraud, improper or misleading conduct of its owner, inadequate capital or income for the LLC's business operations, or its owner's commingling assets as an alter ego of the LLC. Unlike a corporation, however, failure of an LLC to observe meeting, documentation, and other entity governance formalities alone do not justify piercing its veil. And like professional corporations, like a PC, professional LLCs, like a PL or PLLC in Florida, such as law and accounting firms, do not protect their owners, the licensed professionals in the practices of those entities, from liability for their own malpractice. Since amendment of the Florida LLC statute, effective January 1, 2014, which I'll discuss in much greater detail later in this presentation, a Florida LLC as well as a Florida corporation can purchase the interest of its member or its shareholder that commenced an action for judicial dissolution in order to avert that dissolution. For other common features of Florida corporations and LLCs, see slides 8 to 10 of this presentation. Slides 11 through 12 of this presentation overview the advantages of selecting a Florida LLC over a Florida corporation as the entity in which to conduct business. What are the advantages of forming a business entity as a Florida LLC over forming it as a Florida corporation? I shall discuss shortly one of the principal advantages of an LLC over a corporation for a business that is asset intensive. Entity asset protection, resulting from the exclusivity of the charging order remedy of a judgment creditor of an owner of the entity. Discussing the other advantages now, however, generally, in addition to that entity asset protection, the advantages of Florida LLCs over Florida corporations include reduced and simplified documentation, including documentation for issuing additional ownership interest in the LLC, and reduced and simplified requirements for indemnifying management for LLCs and for corporations. Greater flexibility in establishing or limiting by provisions of the LLC's Articles of Organization or Operating Agreement the fiduciary duties, authority, and voting rights of members, managers, and others, and establishing formulae for distributions and allocations of profits, depreciation, and losses than for corporations. Certain lower ongoing fees payable to the Florida Department of State for LLCs than for corporations. Permitted dissociation of a member as a member of the LLC while retaining a transferable ownership interest in the LLC's distributions as a transferee without, however, voting or management rights. Although this permitted dissociation of a member and its remaining a transferee may be a disadvantage of an LLC over a corporation under some circumstances. And finally, another advantage of Florida LLCs over Florida corporations, there's, as contrasted particularly with an S corporation, because of restrictions on the ownership of S corporations, to which I alluded earlier in the presentation, opportunities to protect the identities of owners of the LLC by using layers of ownership exist that don't exist for an S corporation. See slides 11 and 12 for more detailed discussion of these disadvantages. Also, I call your attention again to the memorandum accompanying this PowerPoint, the summaries that contains summaries of judicial opinions regarding, among other things, the preeminence of the LLC operating agreement over the LLC statute, and in particular, its preeminence regarding actions by LLC members against other LLC members that appear on page 1 of that memorandum of judicial opinions, included on page 29 of the materials for this presentation. For example, the Florida 3rd District Court of Appeal held on February 28, 2018, just a few months ago, in FERC Family LP versus Frank, cited in that memorandum, that under sections 605.0105 subsections 2, 3 little a in the whole, and 3 little k in the whole, Florida statutes, an LLC member may bring a direct, not only a derivative, action against another LLC member if the operating agreement so provides, even if the plaintiff LLC member fails to satisfy the requirements of section 605.0801 Florida statutes, that the plaintiff plead and prove an actual or threatened injury that is not solely the result of an injury suffered or threatened to be suffered by the LLC. So LLC members are not limited to derivative actions against their other members. They can bring direct actions under that case decision. Slides 13 to 15 of this presentation concern disadvantages of selecting the Florida LLCs over Florida corporations as the choice of entity for businesses, new businesses, or even reorganized businesses. There are disadvantages of Florida LLCs over Florida corporations, in addition to the ease of dissociation of a member as a member while retaining a transferable ownership interest in the LLC as a transferee without voting or management rights. Those disadvantages include the requirement of inclusion in the LLC operating agreement of any restrictions on transferability of membership interests, whereas shares of a corporation generally are restricted as to transfer without those restricting provisions in the shareholders' agreements. Another disadvantage is automatic dissolution of the LLC on the 90th consecutive day with no member unless transferees of membership interests that own rights to receive a majority of distribution consent to admit at least one member. Remember, one of the features of an LLC that does not exist in a corporation or even an S corporation is the possibility that a member may disassociate but remain a transferee. One circumstances that example of that situation that we'll discuss in more detail later, the entity asset protection situation, is a judgment creditor of a member levying on that member's interest in the LLC, and under the circumstances we'll describe later in this presentation, that judgment creditor having the rights after that levy only of a transferee or assignee of that member's interest, not the right to become a full voting and management influencing member of the LLC. Under either of those circumstances, whether there's a dissociation or judgment creditor takes over by assignment or levy the interests of a transferee and a member, there may be some circumstances where there are transferees of an economic persons of interest in an LLC that are not actually voting or management influencing members of the LLC, so that an LLC may at some point not have a member. Under those circumstances, unless those transferees select at least one full voting member and management controlling member of that LLC, the LLC will automatically dissolve, unlike corporations that have perpetual existence. LLCs, like partnerships, do not have guaranteed perpetual existence until they are affirmatively dissolved by action of the owners themselves. Another disadvantage of selecting a Florida LLC over a Florida corporation as the entity in which to conduct business is that there are more limited rights of agents of LLCs to advancement of expenses and to indemnification from the LLC than exist for agents of corporations. For a number of reasons outlined on slide 14 of this presentation, some of which we've already discussed, LLCs may be of lesser appeal than corporations are to certain prospective investors, particularly hedge funds, venture capitalists, and they may be of lesser appeal to investment bankers who are retained to promote to effect a public offering of the entity. This, of course, is not generally a concern for most small businesses in Florida, although some, particularly entrepreneurial firms in the tech space, do seek capital for venture capitalists and hedge funds, and they may find, notwithstanding the other advantages, many advantages I've outlined for selecting the LLC form, that their primary 800-pound gorilla in the room investor, venture capitalist or hedge fund, may object to the LLC for, among other reasons, the newness, relative newness of LLCs, although LLCs have now been around and have been relatively easy to operate from a tax perspective since the tax law changed about LLCs in 1997. But the public generally is not as familiar with LLCs. There are very few LLCs that go public and that you find on any of the major exchanges. They also may be very concerned about the entity asset protection feature that we're going to discuss in a few minutes, because that could adversely affect the interests of the hedge fund or the venture capitalist, and in some cases being in the form of lenders or preferred creditors rather than, or preferred owners as distinguished from the equivalent of common stockholders of a corporation. So I urge you to study slide 14 because it has its own unique factors. Slide 15 continues with the disadvantages of Florida LLCs over Florida corporations. There are no incentive stock options in LLCs, unlike corporations. The tax laws do not provide for those benefits for an LLC. There are more stringent financial records and financial statements requirements for LLCs under the LLC statute in Florida. And there are certain higher initial organizational fees payable to the Florida Department of State for LLCs than for corporations. Again, I urge you to study slides 13 to 15, as well as the earlier slides 2 to 7 of this presentation regarding taxation considerations that I discussed earlier, as well as slides 20 to 21 regarding indemnification of Florida LLC members and managers under Section 605.0408 Florida statutes in the Florida Revised LLC Act, effective January 1, 2014. In contrast, the indemnification of Florida corporation shareholders under Sections 607.0850 and 607.1621, subsection 1, Florida statutes in the Florida Business Corporation Act. We're going to jump ahead a bit to slide 20 and 21, slides 20 and 21, that talk about those indemnification provisions under Section 605.0408 Florida statutes in the Florida Current Limited Liability Company statute. Under that section, an LLC may advance reasonable expenses to and indemnify only its former or present member or manager, not other agents of the LLC, unless, of course, the operating agreement or another agreement otherwise provides. And as we're going to hammer on even further than we have in the previous portions of this presentation, the LLC is very much a creature of statute, and the operating agreement is king in the context of the LLC, as in sharp contrast to the effect of a shareholders agreement in a corporation. Under 605.0408, an LLC may not indemnify its former or present member or manager for claims arising from certain breaches by them of their duties. Again, I will outline those duties that cannot be indemnified against in my discussion of recent changes to the Florida LLC statute. That's outlined on slide 21. If you're interested in looking at that now. Indemnification by an LLC is not mandatory even if the LLC's former or present member or manager successfully defends a proceeding, in contrast to Section 607.0850 Florida statutes in the Florida Business Corporation Act. An LLC need not report to its members regarding its indemnification or advances of expenses other than by court order. Unlike a corporation under 607.1621 subsection 1 Florida statutes in the Florida Business Corporation Act. Also, see the summaries to which I referred earlier of judicial opinions regarding indemnification by Florida LLCs other than of members of member-managed LLCs or of managers on page 1 of the Memorandum of Judicial Opinions included on page 29 of the materials for this presentation. Especially the opinion of the Florida 3rd District Court of Appeals on September 6, 2017 in MVW Management, LLC versus Regalia Beach Developers, LLC. That court observed that Florida law generally disfavors contracts that shift the cost of a party's misconduct from the, I apologize if there's a call coming in. I hope it doesn't disturb you too much. It will stop in a moment. I couldn't cut it off, unfortunately. That court observed that Florida law generally disfavors contracts that shift the cost of a party's misconduct from the perpetrator to the injured party, so that agreements, even operating agreement provisions, for direct indemnification or advancement of expenses in first-party actions, like exculpatory clauses, are not inferred and are enforceable if and only if the wording is so clear, unambiguous, and understandable that an ordinary and knowledgeable person will know what he or she, or in the case of an LLC, it, is contracting away. Rather, in Florida, indemnity provisions generally apply only to third-party claims. Because LLCs are governed predominantly by contract rather than by statute, the court in MVW Management looked to applicable agreements rather than the Florida LLC statute to determine rights to indemnification of an agent of the LLC, in this case a manager. In contrast, Section 607.0850 Florida statutes in the Florida Business Corporation Act expressly authorizes indemnification of attorney's fees and costs by a corporation to its director in a derivative action against that director, and also certain agents and employees of the corporation. Again, we can attribute this difference in approach for LLCs and corporations to the historical difference in law applicable to LLCs and corporations. LLCs, although creatures of statute like corporations, derived conceptually from the law of partnerships and limited partnerships, which in turn derived primarily from the common law of contract. Now we're going to get back into the queue and return to slides 16 to 18 that cover the topic that I promised I would cover with you in detail, namely protection of LLC assets from the creditors of members. As I mentioned earlier, one of the principal advantages of an LLC over a corporation for a business that is asset intensive is entity asset protection, resulting from the exclusivity of the charging order remedy of a judgment creditor of an owner of the entity. Most state LLC statutes, modeled after the Uniform Partnership and Limited Partnership Acts, provide that the rights of creditors of members of an LLC, like the rights of creditors of partners, are limited to the rights of a transferee or an assignee of an ownership interest in the respective entity. That is, the right to a charging order to distributions from the entity if, as, and when made, not the right to the ownership of the membership interest itself, including, in that membership interest itself, voting and management rights attributable to that ownership interest. This limitation means that a member's creditor that is limited to a charging order against that member's interest cannot vote that member's interest in favor of dissolution of the LLC, and therefore cannot obtain ownership and the right to sell assets of the LLC to satisfy the debt of the member to that creditor. Although some commentators cautioned before 2010 that this charging order limitation was intended to protect the interests of partners and LLC members other than the debtor, partner, or member, and therefore should not apply to sole proprietorships or single-member LLCs, the business and legal community in Florida generally assumed that the clear text of the Florida LLC Act, applicable before 2014, applied the charging order limitation to creditors of any member of any LLC, regardless whether the LLC was multi-member. In 2010, the Florida Supreme Court in Olmstead versus Federal Trade Commission upended that assumption, at least for LLCs formed under Florida law. That opinion is cited on slide 16 and on page 3 of the Memorandum of Judicial Opinions included on page 31 of the materials for this presentation. The court held in Olmstead that exclusiveness of the charging order remedy of a Florida LLC member's judgment creditor with respect to that member's membership interest in that LLC did not apply to a single member LLC, so that the court could order the judgment creditor qua LLC member, it could order the judgment debtor, qua LLC member, to surrender all right, title, and interest in that LLC to satisfy that judgment. In other words, reverse piercing. Slide 17 covers what the response the Florida Bar and the judiciary and the legislature took to that decision in Olmstead. After amendments to the Florida LLC Act effective May 31, 2011, known as the Olmstead Patch, which was heavily lobbied for by the Florida Bar, the charging order continues as the sole and exclusive remedy of a judgment creditor against membership interests or distribution rights of members of a multi-member Florida LLC. That creditor lacks the right to execute under Section 56.061 Florida statutes on, foreclose under Section 605.0503 subsection 6 Florida statute against, vote, participate in management in respect of, or sell those membership interests in the multi-member Florida LLC. In other words, to the multi-member LLCs having 2 or more members, the law today, since 2011, is pretty much what it was before 2010 in Olmstead, which is that a judgment creditor of a member of a multi-member LLC cannot execute on that membership interest, cannot foreclose against that membership interest, cannot vote the voting rights that that membership interest carries, cannot participate in management in respect of that membership interest, and cannot sell that membership interest. But that continuation of the rule applies only to multi-member Florida LLCs, which were not affected by the opinion in the Olmstead Supreme Court case in 2010. The Olmstead Patch, now described on slide 18 of this presentation, as reflected in section 605.0503 subsection 4 Florida statutes, provides that if a judgment creditor of a member of a single member LLC or that member's transferee within a reasonable time at any time after entry of the judgment establishes to the court's satisfaction that, and I'm quoting from the statute now, distributions under a charging order will not satisfy the judgment within a reasonable time, then the charging order is not the sole and exclusive remedy of that creditor with respect to that judgment debtor qua LLC member, and the court may order the foreclosure sale of that interest, and the purchaser at the court-ordered foreclosure sale obtains that entire interest, not merely the rights of a transferee or assignee, and that judgment creditor becomes a member of the LLC, whereas the judgment debtor ceases to be a member of the LLC. Now note that this Olmstead Patch, this statutory amendment, was intended to mollify, to, in some ways, to reduce the harshness of the conclusion in the opinion of Olmstead, which was to the effect that under no circumstances could a membership interest in a single member LLC be protected by the charging order limitations that existed, we thought existed for all LLCs before the Olmstead opinion. Now, the holding of the Olmstead opinion regarding single-member LLCs effectively by statutory amendment is limited to those circumstances in which the judgment creditor can establish to the court's satisfaction that distributions under a charging order will not satisfy the judgment within a reasonable time. Under other circumstances, if distributions cannot be established not to be sufficient to satisfy the judgment within a reasonable time, the judgment creditor, even of the membership interest in a single member LLC, will be limited to that charging order limitation, namely those distributions, and that judgment creditor of the single member LLC will not be entitled to levy upon, to vote, the membership interest to engage in management of the membership interest, to dissolve the single-member LLC, and to sell its assets. See pages 3 and 4 of the Memorandum of Judicial Opinions included on pages 31 and 32 of the materials for this presentation summarizing judicial opinions, which follow and distinguish the holding in Olmstead after effectiveness of the Olmstead Patch statutory amendments in 2011. For example, in the Memorandum of Judicial Opinions, the United States District Court for the Middle District of Florida held in 2016 in Branch Banking and Trust Company versus Crystal Center, LLC, that the exclusivity of the charging order remedy of a judgment creditor, quote, does not deprive a member or transferee of a membership interest in the limited liability company of the benefit of any exemption law applicable to the transferable interest of the member or transferee. So that in that case, a membership interest held by a married couple as a tenancy by the entireties and therefore belonging to neither spouse individually, but rather seized in its entirety by each spouse, is not executable by a judgment creditor of only one spouse. In other words, there are two sets of parallel laws involved. There is a charging order exclusivity remedy provisions of the Florida Limited Liability Company Act, as revised in 2014, and there are separate protections provided for a membership interest for interests that are held as tenancy by the entireties by married couples. The Florida First District Court of Appeal held on November 30, 2017, in Capstone Bank versus Perry-Clifton Enterprises, LLC, that a divorce judgment is not a de facto charging order under Florida law, and that the divorced spouse and judgment creditor, the divorced spouse being the judgment creditor of an LLC member, namely the former spouse, must file a motion for a charging order for one to be issued in addition to the divorce judgment, which charging order enables a lien against distribution to that LLC member from that LLC. So, in other words, a spouse is obtaining a marriage dissolution decree and judgment does not in and of itself entitle that spouse to any rights with respect to his or her former spouse's ownership interest in an LLC, regardless whether it's a single-member LLC or a multi-member LLC. That divorced judgment spouse must also obtain a charging order in order to obtain the rights either to distribution or, in the case of a single-member LLC, if the distributions would not be sufficient to satisfy the judgment of divorce, then possibly rights to actual full membership in that LLC. We've already covered the substance of slides 19 to 21, so we're going to skip ahead now to slide 22. These slides 22 to 32 concern very intensely circumstances in which the LLC operating agreement does govern over the LLC statute and its articles of organization, and circumstances when it does not govern over the LLC statute and the LLC's articles of organization. I believe that these slides 22 to 31 are the most valuable of all of the materials for this presentation. They are the result of my personal detailed analysis of the Florida Revised LLC Act effective January 1, 2014 to determine what provisions of an operating agreement for a Florida LLC are effective and enforceable even if they are inconsistent with the default governance rules stated in that statute, and for relationships among members, associated members, transferees, and managers, even if they are inconsistent with the Articles of Organization of the Florida LLC. Now, persons other than members, associated members, transferees, and managers of the LLCs, in other words, third parties, outsiders, may rely on the Articles of Organization, however, because the Articles of Organization is a public document and the operating agreement generally is not available to the public unless the LLC happens to be a public company, but that's outside the scope of this presentation. Those third parties may rely on the Articles of Organization unless they are advised that the LLC's operating agreement conflicts with the Articles of Organization, or their reliance on the Articles of Organization otherwise is unreasonable. In other words, if there are other circumstances that would give a third party reason to know that there is an operating agreement, LLC operating agreement provision that contradicts the provisions of the Articles of Organization. And that would be a facts and circumstances determination, of course, by a court or an arbitrator in a dispute. Again, see the summaries of judicial opinions regarding the preeminence of the LLC operating agreement over the LLC statute regarding actions by LLC members against other LLC members on page 1 of the Memorandum of Judicial Opinions included on page 29 of the materials for this presentation. Those slides 22 to 31, should serve as your checklist when drafting or marking up a form of LLC operating agreement, or when analyzing an LLC operating agreement in connection with litigation, arbitration, mediation, or any other dispute involving an LLC. Every LLC formed under Florida law must, by that law, have an operating agreement, not necessarily denominated as an operating or LLC agreement, although that agreement may be oral, implied, in a written, electronic, or other tangible medium. These written, electronic, or other tangible medium are referred to in the LLC statute as a record. That's the defined term. Or the operating agreement may be any combination of these forms. And the operating agreement is not subject to the statute of frauds. It is nevertheless required. Of course, any agreement not in writing or not signed by all interested parties, even by a single member LLC and its sole member, is just asking for trouble. The LLC and each of its members, transferees, and managers is bound by and may enforce its operating agreement regardless whether any of them manifests assent or signs it. Now, slides 30, 23, and 24 begins our discussion of circumstances of operating agreement provisions in which operating agreement provisions that do prevail over the statute of the Articles of Organization, at least as to insiders. Although Section 605.0105, subsection 3, Florida statutes, lists all purported provisions of a Florida LLC operating agreement that are not enforceable if inconsistent with the Florida Revised LLC Act, the list in Section 605.0105, subsection 4, Florida statutes, of provisions of a Florida LLC operating agreement that are permitted and enforceable, even if inconsistent with that statute, is not exclusive. See slides 28 to 31 for purported provisions of an operating agreement that are not enforceable if inconsistent with that statute. And see slides 23 to 27 of this presentation for the non-exclusive list of provisions of an operating agreement that are enforceable even if they are inconsistent with the LLC statute in Florida. Those provisions of an operating agreement that are enforceable, even if they are inconsistent with that Florida LLC statute, include, among others, starting on slide 25, providing means for authorization or ratification of violation of the duty of loyalty, for example, a conflict of interest. altering the statutory limitation on distributions to require solely that total assets not be less than the sum of total liabilities. Eliminating or limiting a duty or obligation of a member pertaining to that member's responsibility relieved by the operating agreement of a member-managed LLC. Imposing reasonable restrictions on the availability and use by a member or manager of information obtained by that member under the LLC statute. And definition of appropriate remedies, including liquidated damages for breach by that member of those reasonable restrictions. Precluding appointment by the LLC of a special litigation committee, generally in connection with a derivative action. Providing rights to a person even if that person is not a party to the operating agreement. Continuing on slide 26, requiring approval of amendment of the operating agreement by a person not a party to it, such as a lender or landlord, or upon satisfaction of a condition. Modifying unanimous vote of members required to admit new members or to amend the Articles of Organization or operating agreement. Again, a provision that's permitted and enforceable even if it's inconsistent with the LLC operating agreement. Authorizing, even if it's inconsistent with the statute, authorizing members having no right to distributions from or obligations to contribute to the LLC. Basing distributions from the LLC on members' respective capital contributions instead of on the percentage interest of those members that's used for other purposes in the operating agreement, such as voting. Moving to slide 27. Again, more provisions of an operating agreement that are enforceable even if inconsistent with the statute. If not, and this is a series of provisions of the operating agreement that are enforceable only if they are not manifestly unreasonable. If not manifestly unreasonable, altering or eliminating aspects, but not all of, the duty of loyalty or any other fiduciary duty except the duty of care. If not manifestly unreasonable, identifying specific types or categories of activities not violating the duty of loyalty. Again, the duty of loyalty, for example, includes conflicts of interest. If not manifestly unreasonable, altering the duty of care, that is negligence, but not authorizing willful or intentional misconduct or a knowing violation of law. Again, I'm going to repeat that about the duty of care or negligence of a director. And this is separate and apart from the business. This is actually part and parcel of the business judgment rule as applied in the LLC context. If not manifestly unreasonable, the operating agreement of an LLC can alter the duty of care or the standards of negligence, but it may not effectively authorize the willful or intentional misconduct or a knowing violation of law by a member of a member-managed LLC or by a manager of a manager-managed LLC. And if not manifestly unreasonable, the operating agreement, even if inconsistent with the statute, may prescribe standards to measure performance of the obligation of good faith and fair dealing. Again, the operating agreement may not absolutely eliminate the obligation of good faith and fair dealing, as we'll get into more detail in a few minutes. Slide 28 begins the discussion of those provisions of an operating agreement that are not enforceable if inconsistent with the Florida Revised LLC Act. Those provisions that are not enforceable are limited to the following: bearing the LLC's capacity to sue and be sued in its own name, varying the law governing the internal affairs of the LLC, varying the law governing the internal affairs of the LLC, or the liability of a member as a member or of a manager as a manager for debts, obligations, or other liabilities of the LLC. Varying any provision of the LLC statute regarding registered agents or the Florida Department of State, including provisions regarding records authorized or required to be delivered to the Florida Department of State for filing. Varying provisions of the LLC statute regarding signing or filing a record under judicial order. Again, record is defined in the statute as any tangible medium in which any kind of records relating to the LLC are maintained. Again, another provision that is not effective in the operating agreement if it's inconsistent with the statute, eliminating the duty of loyalty or the duty of care, or authorizing or relieving or exonerating a person for liability from, or exonerating a person from liability for bad faith, willful or intentional misconduct, or a knowing violation of law by a manager or managing member. Except that, as I noted a few minutes ago, the operating agreement may eliminate aspects and identify specific types and categories of activities that do not violate the duty of loyalty, such as conflicts of interest, if that provision is not manifestly unreasonable. Moving on to slide 29, other provisions of an operating agreement that are not effective if they are inconsistent with the statute. Eliminating the obligation of good faith and fair dealing of a manager or managing member, except to the extent that I previously mentioned regarding prescribing standards for that duty. Unreasonably restricting duties and rights regarding books and records and other information required by the LLC statute, except to the extent that I previously mentioned regarding reasonable restrictions on availability and use of that information, and defining appropriate remedies, including liquidated damages for breach of reasonable restrictions on use. Varying the grounds for dissolution under the LLC statute. Varying the statutory requirement to wind up a dissolved LLC's business activities and affairs. Moving on to slide 30, continuing with provisions of an operating agreement that are ineffective if inconsistent with the LLC statute. Unreasonably restricting members' rights to maintain an action against another member or a derivative action. Varying the statutory provisions for a special litigation committee in connection with a derivative action, other than to provide that the LLC may not appoint that committee. Varying members' rights to approve reorganization of the LLC. That is, for example, merger, interest exchange, or conversion of the LLC, all of which are permitted under the LLC statute. But the rights of members to approve those transactions may not be varied by provision of the operating agreement. Varying the required content of the LLC reorganization plans, that is, the plans under which the merger, interest exchange, or conversion of LLCs is effected. Moving on to slide 31. Finally, the provision of an operating agreement that is not effective if inconsistent with the statute would be a provision restricting rights under the LLC statute of persons other than members and managers of the LLC, except to the extent that the statute, that LLC statute expressly permits an operating agreement to restrict the rights of third parties. Now, we discussed again earlier on slide 21 indemnification, I remind you of that slide. You may want to look at that in addition to slide 31. Another provision of an operating agreement that is ineffective if inconsistent with the LLC statute in Florida would be a provision providing for indemnification of a member or manager in violation of the restrictions on indemnification that I noted previously. That's the restrictions on indemnification for breaches of certain duties of managing members or managers, or for a transaction from which the member or manager derived an improper personal benefit, or a circumstance under which the liability provisions of Section 605.0406 Florida statutes regarding improper distributions apply, or the breach of fiduciary and other duties under Section 605.04091 Florida statutes, after taking into account modification of those duties and obligations provided by the operating agreement to the extent that such modification is allowed by Section 605.0105, Section 4, Florida statutes. Now, going back, again, as I said, to slide 21, again, these are provisions that cannot be modified by the provision of the operating agreement. These would be limitations of duties. Just to review those again briefly, because they are very important. Again, those provisions that cannot be eliminated would be provisions that would require the LLC to indemnify its member or manager for any conduct involving bad faith, willful or intentional misconduct, or a knowing violation of law, a transaction from which the member or manager derived an improper personal benefit, or a circumstance under which the liability provisions of Section 605.0406 Florida statutes regarding improper distributions are applicable, and breach of fiduciary and other duties. Turning to slide 31, slides 31 and 32, because many business law clients in Florida request formation of LLCs or corporations under Delaware law instead of Florida law, regardless of, and that includes corporations as well as LLCs formed under Delaware instead of Florida law, regardless of the income and franchise tax disadvantages of their doing so, and their absence of intention or the absence of appropriateness of their business ever affecting a public offering of its securities or going public, I included at slides 31 to 32 the Delaware Limited Liability Company Act provisions regarding limited liability company agreements for LLCs formed under Delaware law. I included those provisions for the purposes of your comparing them with the Florida provisions. Although the Delaware statute is more pro-management than the Florida statute in some respects, neither the Florida nor the Delaware statute permits the operating or limited liability company agreement for an LLC formed in the respective state to eliminate a managing member's or manager's obligation of good faith and fair dealing under the respective statutes, which is a principle of common law of contracts, because LLCs are creatures not of the state, i.e. of statute, but rather creatures of contract. Now we're going to move on in slides 33 to 38 to some of the important changes to the Florida statute that were effected by the Florida Revised Limited Liability Company Act, effective January 1, 2014. There were some provisions that were phased in for a year for LLCs that were formed before January 1, 2014, but as of January 1, 2015, all of those provisions are effective with respect to all LLCs that are formed in the state of Florida. Again, slides 33 to 38 cover these changes or summarize these changes. The extensive changes reflected in the revised Florida statute effective January 1, 2014 are summarized on these slides 33 to 38. Some of the more important changes are limiting the use of the title managing member to a member of a member-managed LLC. There was some confusion about the use of that term. Before 2014, some commentators have stated that that term is no longer permitted to be used by any LLC. That technically is not true. Under circumstances under which it is clear that the managing member refers to a member of a member-managed LLC, which member is designated as the member that manages the LLC, that term is certainly still appropriate to be used and, in fact, is used. Under all circumstances, of course, as to any title, of course, you have to be circumspect and be concerned that the context in which you use the title is not one that causes confusion, and that's true in many contexts of law. Changes and shifting of duties of members are included among the changes to the statute effective January 1, 2014, including modification of duties of loyalty and care by provisions of the operating agreement if the purported modification of duties of loyalty or care is not manifestly unreasonable. These changes or permissive modifications that I referred to earlier in the presentation are new to the statute. Permissible veto of amendments to the operating agreement by persons other than LLC members is new in 2014. Permissible filing with the Florida Department of State of statements of authority and limitations on authority of, and denial of authority by members, managers, or others is a new provision of the LLC statute. The default rule requiring unanimous instead of majority vote of members to admit new members or to amend the articles of organization or operating agreement is new to the statute. Of course, the operating agreement itself could provide other words. So the operating agreement could provide that a majority vote or any other vote is required in order to amend the articles of organization or operating agreement. Move on to slide 34. Again, continuing with the changes to the statute affected by the revision effective January 1, 2014. No indemnification of former or present members or managers from breach of duty is permitted regarding any of the following. And again, I'm repeating some of my discussion of indemnification earlier. No indemnification is permitted regarding distributions by the LLC or for breach of duty involving distributions by the LLC, remuneration to members of a member-managed LLC for their services to that LLC, except as an agreement, including an operating agreement, among members permits. Delegation of rights or powers to manage. Management of a manager-managed LLC. Voting or agency rights of members or managers. Duty of loyalty or duty of care. Again, no indemnification by the LLC is permitted in connection with any breach of duty regarding any of those 7 items, 7 matters that I just described and that I've described earlier in the presentation. Another change affected in 2014 by the statute is that certain conflicts of interest transactions are expressly permissible. And the statute, as amended, prescribes the burden of proof in the event that a conflict of interest transaction is challenged. We have already covered slide number 35, which talks about some of those changes, the implied existence and the necessity of an LLC operating agreement. Moving on to slide 36. Not all members must have, again, continuing with the changes effective January 1, 2014, not all members of an LLC must have rights to distributions or obligations to contribute to the capital of the LLC. Distribution amounts may be calculated based on values of members' contributions without reducing those distribution amounts for amounts of capital previously returned to those members. So in other words, if a member contributed $100 to the LLC and another member contributed $50 to that LLC and $50 of the initial contribution of the first member was returned to that member, so that the net capital contribution or capital account of each of those members in the LLC remains 50-50. Nevertheless, the operating agreement may provide, because the statute is not inconsistent, that each of those members would receive 50% of any distribution, even though, that operating agreement could provide that those members would receive 2/3 to the first and 1/3 to the second, even though the capital account balance in each of those members' capital account circumstances is identical. The calculation may be based on the initial capital contributions without reduction for previous return of capital. Another change that I referred to earlier in the presentation that was effective in January 1, 2014 is the permissibility of dissociation, that is, withdrawal of members of LLCs, like withdrawal of partners from a partnership, while retention of those former members of a transferable interest in the LLC to rights to distributions, although they have lost by that dissociation or withdrawal their rights to vote or manage the LLC. Other changes were affected by the Florida Revised Limited Liability Company Act, effective January 1, 2014, in order to conform the Florida LLC statute to the Florida Corporation statute. Those are outlined on slide 37. Another change effective in 2014 was clarification of the order of priority of the persons to be served with process, notice, or demand on a Florida LLC. 2 statutorily prescribed procedures now exist for serving process on a Florida LLC, and we refer to this in slide 38, and also in the summaries of judicial opinions included in the accompanying memorandum. Service on the LLC's registered agent at its registered office, a member of a member-managed LLC, a manager of a manager-managed LLC, or a designated employee of the LLC available during regular business hours to accept that service is Alternative 1. Alternative 2 is substitute service on the Florida Secretary of State and communicating that substitute service to the defendant in addition to filing the return of service. See the summaries of judicial opinions regarding service of process on Florida LLCs on pages 2 and 3 of the memorandum of judicial opinions included on pages 30 and 31 of the materials for this presentation. The complete citation to the Cornerstone technical case, which was truncated in that summary, is Cornerstone Technical Sales, LLC versus Chassis, CHASSIS Plans, LLC, 2016 U.S. District Lexus 168028 in the U.S. District Court for the Middle District of Florida, Orlando Division, 2016. See slide 39 of this presentation for a summary of the procedure added by Section 605.0715 Florida statute, effective July 1, 2015, to reinstate an administratively dissolved Florida LLC retroactive to the date of administrative dissolution. That reinstatement is effective retroactively, except, as stated on slide 40, as to a person affected by an act or omission in reliance on that dissolution before that person knew or received notice of the reinstatement. The name of a dissolved Florida LLC is not available for 1 year after the effective date of dissolution without the consent of that LLC. That's another change that was effective July 1, 2015. Moving on to slide 41. See the summaries of judicial opinions regarding lawsuits in Florida by Florida LLCs that transact business in Florida on page 2 of the Memorandum of Judicial Opinions included on page 30 of the materials for this presentation. The Super Products LLC opinion of the Florida 2nd District Court of Appeals in February 2017 states that a certificate of authority is required by the Florida Revised LLC Act as a condition for a Florida LLC transacting business in Florida to maintain a lawsuit, but it is not required for it to file that lawsuit, so that the court is authorized to stay a proceeding until the court determines whether that certificate is required, and if so, until that a plaintiff obtains that certificate. Or, alternatively, the court is authorized to continue the proceedings, order that the plaintiff obtain that certificate, and dismiss the complaint if the plaintiff fails to do so. But the court is not authorized initially to dismiss, even without prejudice, the complaint filed by that LLC. Note the possibility of future amendments to the Florida LLC statute to harmonize it with a substantial rewrite of the Florida Business Corporation Act, Chapter 607 Florida Statutes, proposed by a subcommittee, of which I'm a member, of the Corporations, Securities, and Financial Services Committee of the Business Law section of the Florida Bar, which may be submitted, these possible future amendments may be submitted to the Florida legislature as early as its 2018-2019 legislative session. That's this fall. Actually, it's late this fall, early in January. One of the amendments being considered by that subcommittee is including the alleged oppression of minority owners of a business entity by the majority owners as a separate basis for judicial dissolution of that business entity. That term oppression in the proposed amendments probably will be prescribed as to be determined by a court or as defined by a court, but the decision has not yet been made whether to include a more precise definition of oppression for the purposes of that statute. Again, these future amendments are in the early stages of drafting and negotiations within a subcommittee of a committee of the Business Law section of the Florida Bar. They have not yet been submitted either to the full committee on a Corporation, Securities, and Financial Services Committee, or to the full Business Law section, or to the Board of Governors of the Florida Bar. So there's a long road to go before that proposed revised statute in the corporation statute would be submitted to the Florida legislature, and even a longer road to go to harmonize the LLC statute with the proposed amendments to the Florida corporation statute by additional proposed amendments to the LLC Act, over and above those that were enacted in January of 2014. So very exciting prospects, activity going on in Florida in this arena, and I recommend that you stay tuned. In the few minutes remaining for us, we're going to spend a little time on legal ethics issues in representing a Florida LLC or its member. Note the general guidelines on slide 42 regarding the applicability of the Florida Rules of Professional Conduct to evaluation of conduct of attorneys licensed in Florida generally, and the consequences of those Florida licensed attorneys violating those rules. Based upon my experience as an expert witness in legal ethics and attorneys' fiduciary duties in legal malpractice cases, it appears to me that after violation of requirements of trust account maintenance and accounting, the most common basis of disciplinary action and legal malpractice lawsuits against Florida attorneys is alleged conflict of interest, violation of duties of loyalty, if you will, often based upon services of an attorney to more than one owner of a business entity, or to that business entity and one or more of its owners, or based upon that attorney's being required to testify as a witness in a proceeding involving that business entity or one or more of its owners. See, in slide 42, referencing it, the Butler opinion cited on slide 43 regarding impermissibility of an attorney's retaining fees for legal services rendered by that attorney after he or she realizes or should have realized that he or she could not ethically represent that purported client. Rule 4-1.7 governing conflicts of interest is stated on slide 44 now up in front of you. Many Florida attorneys assume incorrectly that obtaining a written conflict waiver from each party that the attorney purports to represent absolves the attorney of all responsibility and consequences of such a conflict of interest. Wrong. As noted on slide 45, even if all of those parties consent in writing after disclosure to them by an attorney that there is a substantial risk that the attorney's representation of one or more of them will be materially limited by the attorney's responsibilities to another of them, or to a former client, or to a third person, or that the attorney's representation of one or more of them will be materially adversely affected by a personal interest of the attorney, that consent is ineffective unless the attorney, and I'm quoting now from the rule, reasonably believes that he or she will be able to provide competent and diligent representation to each affected client. Certain conflicts of interest are so inherently insurmountable as to their effect on the legal services rendered by an attorney as to be unconsentable or non-waivable. See the commentary to that rule quoted on slide 45. The only safe course is not to purport to represent more than one party except a single member LLC and its sole member, even if all members are related by marriage, immediate family, or other close relationship or friendship. The Florida Bar Professional Ethics Committee issued an opinion October 21, 2016 regarding the possible personal interest of an attorney. This is cited on slides 47-48 of the presentation. The opinion outlines the limited and specific circumstances under which an attorney, under the rules, may include in her fee agreement with her clients information about a financing company's providing loans to her clients to pay her fees, the financing fee, and the loan process. A portion of the principal amount of which loan would be retained by the financing company as a financing fee similar to a credit card charge fee. Again, please note my email address so that you can pose questions to me after this presentation. And thank you very much for attending my webinar today.